Hello, this is Jordan. Welcome back to the Daily Gold YouTube channel. Thank you so much for joining me. And welcome back to another episode of Macro Mondays. This is being recorded on the early evening of Monday, October 21st, 2024. And in this video, I'm going to talk about why the U.S. stock market is not going to have a crash anytime soon, despite all of the crash callers all over social media. But why a bear market could be coming. There's an important distinction between those two. So let me get to the video and some charts explaining why I don't see a crash coming anytime soon. So oftentimes we hear, oh, this is 2007 or this is similar to 2008. But if we actually dig in and look at the statistics, there's really no comparison to that. Now I'm going to go through several different charts, or more than a few different charts. And so starting off here, I think this is really important. You have household debt as a share of U.S. GDP. So this is 2008 right here. Look how high it was. Look at all the deleveraging we've gone through. Now this chart's a little old, maybe it's close to a year old, but look at how much household debt has come down as a share of GDP. You did have a pop here during COVID, but as of sometime in late 23, this was at a 20-year low basically. Now, if we talk about the housing market and there's this big housing bubble and, blah, blah, blah. And I mean, there could be, but nothing is really similar to the mid-2000s in terms of housing. Or I shouldn't say nothing. I say the whole picture is not at that scale as far as the potential bubble. So this is the mortgage foreclosure rate, share of loans in foreclosure. Here's the late 2000s right here. This is where we are here and now. I mean, even over a year ago, this was even lower than this period right here. Okay, so moving on. Here is household debt service payments as a percentage of disposable income. So this is where we are right now. Now, this is bounced up. It is coming up, but still, it's nowhere even close to where it was in 2008. Here's another chart. So this is the non-financial corporate net interest cost of U.S. corporations. So this is the Fed funds here in black. Here's the red. Again, corporate net interest payments as a percentage post-tax profits. So this is in the red. So look how high it was at various points. The late 80s, early 90s recession, the recession of 2001, 2008 here. This is where we are here and now. Again, this chart's a little old, not entirely current, but this is like at a minuscule level. Okay, here's another one. Mortgage debt as a percentage of GDP here in red. Again, this is 07, 08. Look at where it is here and now. Again, this is fairly low. This is the lowest since, it's over a 20-year low. Now, household real estate value as a percentage of GDP, I mean, this is definitely stretched. I mean, we could get into a situation where prices come down. Prices could come down a lot in real terms. But again, this is not 2008 for the housing market. Now, here are some more statistics dealing with the health of S&P 500 companies. So S&P 500, the total debt as a percentage of total equity, again, mid-2000s, late 2000s here. This is where we are here and now. So this is debt as a percent of total equity. So you want it to be lower. So this is huge deleveraging here. Now, net debt as a percentage of EBITDA for S&P 500 companies. Again, look at how high this was. This is back around 2005. And then this is 2008. This is where we are here and now. So it is bouncing up a little bit. Last thing, cash and short-term investments as a percent of trailing 12-month EBITDA per share. So this is something that it's healthier if it's higher. So again, here's the mid-2000s here, 2008, and big move high. I mean, here's a peak with all the free COVID money, and it's come down, but still, it's right here, way above where it was in 2008. Okay, let's talk about energy. Remember all those years where we weren't producing enough energy and, the huge trade deficit and, where oil is a serious long-term problem. I mean, it probably is. But the U.S., we are now producing more than we are consuming as far as energy, primary energy. And again, this is 2008. This is where we were back here. This is where we're consuming. So this is another important indicator. I mean, if the oil price spikes, which it will again at some point, it's not going to hurt us as much as it did in past recessions. Now, with all that being said, I am not saying that buy and hold stocks, everything is honky-dory, everything's going to continue for another 10 years or 5 or 7 years before we get the inevitable big crash. I'm just saying it's not going to happen tomorrow. But still, when we look at the stock market, we take a historical look, we look at various indicators, we are coming close to the end of a secular bull. And maybe in real terms against gold, maybe that could peak early next year or late this year. Who knows? So I want to look at the stock market and just assess where we are, and it really provides some important indicators of why we're not going to crash. And by the way, I mean, we have to define what a crash is, because the word gets used way too much. I mean, I think of 87 or I think of 29. That was obviously a crash. 87 was obviously a crash. You could say COVID. That was obviously a crash. And then you can also throw in, the middle or summer of 2008, also 74, 73. I mean, you could throw those in there. So there's a difference between a crash and a bear market. But anyway, so these are the secular bear markets here. This red line, that shows the secular bull peaks, 29, 68, 2000. This is the CAPE ratio. So this is the 10-year PE ratio. Now, back in 2000, the market was 34% tech. It's 44% tech now, but in 2000, it's just that if you took out the tech stocks, the rest of the market was really not overvalued. So this was just an epic, massive tech bubble. I mean, we probably have a tech bubble again today, but nowhere near the degree of 2000. And if we look at the CAPE, so it's at 36 now. It was a little higher at about 40 at the end of 21. If we get some kind of blow off in the next year and this goes up like this, then maybe that could raise the crash risk. But here's an important thing to remember. One reason you had a big crash here and not here was because bonds were still in a secular bull market. So people, they could dump their stocks, put the money in bonds, and still make money in bonds. So if you look at the 60-40 portfolio, I don't have it in this chart, but if you look at the total real return of the 60-40 portfolio, this was the worst bear market for the 60-40 portfolio, not this and this right here, because bonds were still going up here. We could see, so here's my total return calculation for bonds. It's in a bear now. It's in a secular bear now. It wasn't a secular bear here, but here it was still in a secular bull. You can't see the data. It was still in a secular bull, because you can see this is the 10-year yield, and it did go up a little bit in 31, but still, it was still going down. You're still in a secular bull, going up here and going down here. So this is a very important point. Bonds are in a secular bear now, just like they fell into in 1965. So this secular bear in stocks, bonds are in a secular bear. Bonds are in a secular bull here and here. So if bonds are in a secular bull, there's more crash potential because people can just dump their stocks. Oh, I'm going to go into bonds. They're safe. But now, because bonds are in a secular bear, like here, and inflation is a problem, that's going to make them a little more willing to hold on to their stocks. So that, amongst other reasons, is why I think we're setting up for something like this. So that's the importance of bonds. Again, this is total return divided by inflation. So bonds here falling into a secular bear like they did here. So that's why I think, again, why I think we could be setting up for something like this. No crash. And inflation also plays a role, obviously. This was inflation in that period. This is a 10-year moving average. Yes, statistical inflation has come down, but it's not falling below the moving average. We know if there's not a recession, next year, in the next 6 or 9 months, this is going to turn up like that. Again, this is probably the third or fourth time I've said it, but we're setting up for something like this, not a crash like 29 or 2000. Okay, last slide. And, there's no crash, but we could get a severe secular bear market as far as total real return. So again, we go back here. So this is the crash in 29, the crash in 2000. But so there was no crash in this period. And if inflation picks up again, we'll hear all this stuff, all this talk about, well, stocks are a long-term inflation hedge. They're not. I mean, look at what happened in this period. This is total real return. So this includes dividends divided by inflation, the total return divided by inflation. So this line here, this is the peak in 1962 to the bottom in 82. So 62 to 82, zero real return for 20 years. This is the peak in 64, 65. This is the bottom in 84. Again, zero real return in 2 decades. So this is a repeat. They won't tell you that this could repeat, or they'll never tell you about this. These silly perma bulls. And the perma bears are just as bad, always calling for a crash. So I know it's a lot to take in for this video, but my point is we're not going to have a crash anytime soon. But this is even worse than a crash, the potential for this over the next 20 years. All right, that's it for the video on Macro Mondays. Let me know what you think. Please leave a comment. And I hope you guys have a great week. I'll talk to you again in the next video.